We'll now turn to member questions, and I've recognized myself for 5 minutes for questions. Mr. Dubay, should we reevaluate some of the micro-prudential authorities given to the Fed in Dodd-Frank? Is the Fed responsible for too much?
I think at this point, 15 years past Dodd-Frank, that it's time to reevaluate whether that's the proper function of the Fed. The idea of macroprudential regulation and evaluating fiscal stability is financial stability of the entire system is a good one. But we have other organizations, other independent agencies that can do that as well. And it's definitely time to examine whether we should reorganize how financial stability is maintained.
On that same thing, Mr. Dubay, do the Fed's regulatory and supervisory functions interfere with its ability to be independent when setting monetary policy?
The Fed has a lot on its plate, and it would be much better for the Fed if it could focus solely on setting monetary policy alone. Of course, part of that is supervising the banks that are its members, but so I think we need to be clear to separate its role as a regulator for the banks that are its members and the kind of the macroprudential analysis that it also has to do.
Dr. Holtz-Aiken, can you expand on your testimony and talk about the transmission of monetary policy through forward guidance and the Fed's communications, and how can the Fed improve in reducing uncertainty for the market participants?
Certainly. The Fed has a very hard job at the moment. It has to convey to market participants the future path of interest rates, and in doing so, it has to convey how it will evaluate future trade-offs between inflation and unemployment. It has to convey how it will evaluate the recovery from errors in hitting targets on inflation. They're trying to get to the 2% target. How fast will they do that? How slowly will they do that? And that's an enormous amount of future judgment that they have to provide some guidance about. And there's no guarantee that the future Fed will agree with that guidance, and thus market participants get wrong-footed quite a bit. One of the reasons that I think moving to a single mandate, and particularly a price level mandate, has virtues is that it doesn't forgive past mistakes. Market participants know that if they overshoot on inflation, they got to get back to the target. If they undershoot, they got to get it back up to the target. And there's much more of an anchoring of future expectations, and anchoring the yield curve and expectations of future cost of capital is everything for generating good employment outcomes. So I think it would improve the overall performance.
Continuing with you, Dr. Holtz-Aiken, can you talk about why it's important for the Fed to take into account a variety of indicators, including labor market conditions and businesses' access to credit when setting policy?
Certainly. I mean, the Fed has to take this enormous $30 trillion economy and condense it down to decisions and guidance about future decisions on interest rates. There is no way that they can do better by ignoring information. So knowing the status of labor markets, including regionally, knowing conditions in the global markets, knowing what other monetary authorities are doing are all important to their mission, and they are doing their very best to accumulate this information and process it every meeting.
Mr. Pollack, in my remaining time, the Fed just wrapped up its 5-year framework review. Were there policies you felt that were left unaddressed that should have warranted their attention in that review? You've got a minute, sorry. Go.
Sorry. Mr. Chairman, I think absolutely there was something very important left out, which was a review of the 2% inflation forever doctrine itself. The Fed announced that didn't even come up for review, that it was carved in stone, as it were. That is the very thing I think that the Congress and the Fed ought to be thinking about. Are we in this for perpetual inflation or for sound money and long-term stable prices, and therefore maximum employment and growth?
Thank you, sir. And I'll yield back the remaining 14 seconds of my time